Okay, law number 6. A trend in motion tends to stay in motion. Now, this is something that's actually pretty readily explainable, and we don't need to get into the charts to explain what this means and why. Okay, once a trend has started, it's more likely to keep going than it is to reverse. And this can be explained from a couple different perspectives. One is if you think about the normal laws of movement, the laws of physics, right? When something starts moving, it's easier for it to continue with that momentum and keep moving than it is to stop it, right? Even if a car is moving and then you shut off the engine, it's going to keep rolling and moving. And to stop it, you're going to have to put a major force in front of it to make it stop instantly, right? So whenever we have a new trend that starts, it takes a lot to make it just stop. It's not just going to stop and reverse instantly, unless it wasn't a real trend to begin with. But once a real trend is in motion, it does tend to stay in motion. Right? And the other reason why, other than explaining it from the laws of, let's say, physics, you look at the psychology behind it, crowd behavior. When a trend starts, it attracts other people. The higher prices, let's say in case of an uptrend, attract buyers. They look at it and now they want to get in because they see the higher prices. And that causes the prices to go even higher. And that attracts more people to go in because they want to profit. You know, it's the human psychology, the greed aspect. So again, once you look at the markets, not as patterns as and all these things that you just see on charts, but always think about what it means from an underlying perspective, from a deeper basis. It makes things much easier to understand. And so this law basically will later allow you to not get in trouble by standing in the way of a trend. Once you see a strong trend moving, remembering this law is going to allow you to not try to be that force that stands in front of it. Okay? So if you see a strong up move, you don't really want to sell into that if it's a strong trend, because it tends to stay in motion once it's already in motion. Now, law number 7 is basically deducible from law number 5, which said that trends start after a climax or from a balance area. Well, that would naturally mean that trends end with a climax or a balance area, right? If a trend is starting from this, that means the previous trend that has ended must have ended in these general conditions. So again, this is just something to understand. If you are on board of an existing trend or you're seeing an existing trend in the market, then you realize that it's likely to end in one of two ways. Either one, it's going to hit a major climax, whether it's a major buying climax or selling climax, and then going to start moving the other way. Or two, it's going to hit a stopping point, right? And then start balancing around that, building value around that. And it'll either continue, or in this case, in this law, it'll start moving the other direction. There will be a breakout to the other side of that balance, and a new trend will start in the other way. Okay, and now we move on to law number 8, which is that high volume on the vertical scale signifies directional conviction and rejection of value. What this law is going to explain is what causes these trends, what creates the directional movement. So let's take a look at a price chart to see. Okay, we're back to the S&P 500 5-minute chart. And I want to explain what this law means visually. All right? Now, the law mentions volume on the vertical scale. Okay, what does this mean and why do you say vertical scale? That's because there's two types of volume. The vertical scale and the horizontal scale. Okay? The vertical scale is this. You see, this is a volume bar, and this corresponds to this bar right here. Now, it's a vertical scale because this bar is going to either be moving up or down, right? And this is going to measure the volume that was in this bar. And then we're going to move to the next one, and it's going to measure the volume in the next one. Okay? Now, high volume often signifies directional conviction. And it often signifies the big market players are in the market. Now, up till now, we've talked about market participants on a general basis as like human beings. But when you go deeper into that, there's different types of market participants. There's the professionals, the institutions, and the retail crowd. Okay? In general, what makes the markets move, what causes real movements that cause trends to occur, are the major players, the institutions and the professionals. The retail crowd is usually the one that comes in either in the middle or at the end of the moves, after they've seen the major price changes, after they've seen the big up move and they get excited and they want to come in. But it's the institutions and the pros that start the moves. And you can see that they're at play in the market once you see the large volume. All right? Because the institutions are trading huge amounts of contracts. And when they come into the market and they're buying aggressively, you're going to see it on the volume chart. It's going to show up as a lot of volume. Whereas the retail crowd will only generate a lot of volume when they're moving in mass, right? In huge numbers. And that's usually at the end of moves because they're always on the wrong side of the move. Now, one thing I want to caution here is that, again, this is a general law, general framework to help you understand things, but don't take it and apply it as an exact law that's always there, because that's going to get you into trouble, right? A lot of times you can get good moves on low volume. And so that doesn't mean that it's not real. I mean, there will be a lot of people that tell you out there moves on low volume aren't real. Okay, that's only true if it's a major breakout move. So let's look at this again. Right here we broke out of this major balance area. If this had come on low volume, you'd have good reason to suspect that that move is fake, because it's not the major money players. It's not the major big players in the market that are moving it. The small players, the ones that come in at low volume, are not going to be able to change the whole value area of the market and move it higher. All right? But once we're up there, once we're moving away, once the trend has gotten in motion, it's more likely to stay in motion, and now even smaller volume can sustain that. So it's always contextual. You have to think about where is this big volume coming. And I'll give you an example. Look at this bar here. And now we've just zeroed into that. This bar here had a lot of volume. So does that mean the big market players were in and driving the market higher and now this thing's going to trend up? Well, no, you got to look at the context. The context is this is coming after a move that was already going up quite a bit. So it's more than likely that this high volume is now the crowd jumping in at the end and it's going to be near the top, which indeed it was. The market ended up going down after that. Okay, so it's contextual. You have to look at it. Large volume on the vertical scale does imply strong conviction if it's what's causing the trend to start out of a balance area on a breakout. That shows good conviction. Okay, and if it's low volume, that shows weak conviction. It's scary to trust that move. In all other instances, right, after a long up move, what it's showing, this big volume, is showing the conviction of the retail crowd, which is usually wrong. So that law is actually a correct statement on both sides, right? Large volume is showing conviction. The question is whose conviction is correct? Usually it's the professional's conviction is correct. So when you see the large volume starting a move, that's usually a good thing. The conviction of the big players is that this thing's going to move higher, so you want to follow them, and the odds are likely that the trend will keep going higher. When you see it after there's already been quite a bit of a move higher, often that's the conviction of the wrong players, and you shouldn't be trusting them. Now, does that mean every time you see high volume at the end of a big move that it will actually be the end of that move? No. It could mean that there's going to be a slight rest and then we're going to keep going higher. People got a little too excited in the short term. The market will take a break and then move higher. Again, these are not hard and fast rules. If they were, I could just give you 15 rules and say, here, trade the market and you'd be profitable. And of course, it's not that easy. And this is why you need all the good training and contextual experience. But all these laws really help you put these things in context and learn faster. And that's the point of these things. And so with that, we get to law number 9, which is that high volume on the horizontal scale signifies value. Now, we've already talked quite a bit about this, but let's contrast that to vertical volume and what the difference is between the two. Because not many traders understand these subtleties. Most traders just look at the vertical volume and don't even understand this whole aspect of the market. Alright, now we've already discussed volume on the horizontal scale quite a bit, and that was when we discussed the market profile chart. That is what horizontal volume is. If you remember, we called it volume at price. How much volume is being transacted at a specific price. And to see that, you have to go horizontally, right? You have to go, okay, at 1430, how much volume transacted? Well, we traded through it here, we came back, traded through it here, we traded through it here, here again, here again, here again. All of this, we traded volume here and here and here and here. All of this is accumulated horizontally to show it here, okay? Whereas the vertical scale, down here, it's accumulated vertically within each bar. Do you understand the difference? Now, vertical shows directional conviction. Horizontal, on the other hand, shows where is value. Where do we keep trading? At which price do we keep trading back and forth through it? Okay, so here we see that this initially was just a directional movement, which would had high volume on the vertical scale, but naturally low volume on the horizontal scale. Now why? Well, because this wasn't value. What the market was doing when it had high conviction, it was perceiving that these prices were a lack of value. That value should be higher, which is why we're moving it higher. This thing is more valuable than it currently is. So let's buy it because we think it's going to be higher. All right? So they're buying a lot, but they're not spending any time at any of these specific prices, which is why volume doesn't accumulate at these prices. There's just a lot of volume at successively higher prices within this period, which gives you this high volume bar. Whereas here, the prices keep going through this area, right? So they accumulate volume at these prices. And it's showing us that, look, now the participants are more equal in their buying and selling. Now they're more equal in their aggressiveness. They agree that yes, now this is a relatively fair value, and so value builds. All right? So horizontal scale shows the value, vertical scale shows the conviction. And these two laws will allow you to understand the market from different perspectives and to see when prices are being accepted, as in here, because we keep trading there, and when they're being rejected, as in here. We're rejecting them, we're getting away from them quickly, and we're going to higher places. So now we get to the last law of our 10 laws, which is that previous market behavior influences current market behavior. Now this law is actually a lot more important than it may seem, because it's going to directly influence a lot of the ways you trade and a lot of the ways you understand how markets move. Now we've been explaining market movement and behavior from certain underlying principles, right? But the one last thing we haven't mentioned yet is that the market is influenced by its own behavior. And this is something that's called a self-fulfilling prophecy a lot of times. So if the market had been dropping very rapidly, for example, and it put in a major low and rejected that and reversed higher, okay, if now we're coming back down towards this low, for whatever reason, even if value in reality, even something had changed, some major news had come out to change the whole outlook, to change the underlying fundamentals of supply and demand, that means that prices should be lower. Once price comes to that level, the previous low, in a high percentage of the times, it's going to react simply because of the previous low. Not because of current underlying fundamentals of supply and demand, but because of the previous market behavior. And there's various reasons why this happens. One, again, if we remember, our major framework is that the markets are made up of human beings, and human beings have memories. Okay? And so if at that previous low, they failed to buy that first time, and they watch prices go up and they, wow, I missed that whole move. Now when it's approaching that low again, they're going to think, well, that price was good last time for a major move. What if it's still good this time? So then they'll buy just on the basis of that previous market action that showed them a major reversal from that area. Okay? Or people that had sold that low, people that were short selling, they were selling near that low, and then the market reversed. And let's say they're still in their position, they hadn't exited. Because, they weren't good traders, they were trading based on fear and hope and all that. Well, now when the market comes back down to that area This is their chance to get out at break even, and they're just breathing a sigh of relief. And to get out of a short selling position, they're going to have to buy their position back. And this causes buying pressure, and it'll cause a bounce at that area just because of the previous market behavior there. You got to realize in the end, all the market participants out there, they're all sitting there looking at charts like you. Even the major hedge fund guys, even the major mutual fund managers, they're looking at charts and they see that there was a previous low there. Okay, they see that. And so now what happens, a third perspective, is that because they know others will be looking at that area, okay, now they'll react to that area based on what they think others will do. And that's where the self-fulfilling prophecy comes in. They'll buy there simply because they think others will buy there. And when everyone does this, the market moves up from that low, despite maybe no real rational reason based on underlying supply-demand fundamentals of why it should. It's based on the behavior of others, and it's based on the self-fulfilling prophecy where others are expecting other traders to do that. And so this is not something to take lightly in the market. A lot of the time, there's these technical things that play out that are a disconnect from the underlying fundamentals. And that's one of the reasons why the markets aren't perfectly efficient. If they were, they'd be only discounting pure fundamental information. And if something came out that said, the market should be at a lower price, well, it would just go there instantly in a straight line. But that's not what really happens. What really happens is that on its way there, previous market behavior is going to influence it and what it does. So just keep this in mind, that you're always thinking about other people. What are they thinking? You're always thinking about the other players, because this helps you to make the correct decisions. And this law will allow you to remember that it's very important to understand the previous context of market behavior, because it will really influence what happens now. And you're going to see that in the next sessions when we talk about key reference areas and support and resistance. And a lot of those are based on this law.